Most people think budgeting is about one question: how much money did I spend? But analysts ask a very different question: how flexible is my financial life? And that changes everything because two people earning the exact same income can have completely different financial risk. One person can survive a job loss for months. Another can collapse financially within weeks. Why? The answer is fixed costs. Today we're introducing one of the most powerful concepts in managerial accounting and applying it to personal finance. This is called the personal contribution income statement. This statement, which is a tool, helps answer the following questions. How financially flexible are you? How much of your lifestyle is locked in? How leveraged is your life? And what happens if income suddenly changes? Because most financial stress doesn't come from spending money, it comes from committing yourself to obligations you cannot easily escape. Traditional budgets usually organize expenses by category: groceries, transportation, entertainment, utilities, subscriptions. But this misses the most important part: which expenses are flexible and which are not. Because when income changes, not all costs behave the same way. Some costs disappear quickly, others remain no matter what happens. That distinction determines financial pressure. Here's the real question. If your income dropped tomorrow, which expenses could immediately fall and which would remain locked in? That's the foundation of financial flexibility. And that's exactly what contribution income statements were designed to be, to analyze in business. We're simply adapting the concept to personal finance. In managerial accounting, businesses often classify costs as fixed, variable, or mixed. Why? Because it helps determine risk, scalability, flexibility, and operating leverage. We can apply the exact same framework to personal finance. So fixed costs. Fixed costs remain relatively stable regardless of short-term lifestyle activity. Examples would include a rent or a mortgage, insurance, phone plans, internet, minimum debt payments, and subscriptions. These are your committed obligations, and they create financial rigidity. Variable costs fluctuate with behavior and lifestyle activity. Examples of these include dining out, gasoline, entertainment, travel, discretionary shopping. These are flexible. They can often be reduced quickly during financial stress. Mixed costs explain that some costs contain both fixed and variable components. Or in other words, they don't behave exactly like variable and they don't behave exactly like fixed obligations. An example of this would be electricity or your hydro or your gas. Part of the bill exists simply because you occupy the property. This is a fixed charge, a fixed delivery charge typically, that will show up. Another portion varies based on your usage. To build this system, we need a new classification layer to the chart of accounts. Not just asset, liability, income, expense, but also we need a cost behavior classification system. So we're either going to classify as fixed, variable, or mixed. This transforms the accounting system from record keeping into analytical infrastructure. So as an example, we may have in our chart of accounts the list of accounts: rent, insurance expense, dining out expense, gasoline, etc. These will be classified into our types, either assets, liabilities, equity, revenue or income, and expense. What we're concerned with is the behavior of our expense accounts. For rent, that behavior would be classified as fixed. For insurance, fixed. For dining out, variable. For gasoline, A portion of this may be variable and a portion of this may be fixed. For example, going to and from work may be a non-negotiable, and so that portion is fixed. It's part of your structure. Now, that being said, any of these could be variable with bigger lifestyle changes. So for instance, you could remove the gasoline expense entirely if you opted to take public transportation. But for our purposes, let's keep gasoline for now variable because it wouldn't take much to sell a car and start taking public transportation. Electricity as an expense, this one, as explained, has mixed characteristic types or characteristic traits. It's going to have a portion that's fixed and a portion that is variable. The same thing for groceries. There's a lot of flexibility or discretion within grocery bills. And so there's a certain portion that you may say is the minimum amount that can be put toward groceries. And then beyond that is a flexible amount or a variable amount. So you may also decide to classify that as mixed. Once we have these all classified, Excel can automatically generate a completely new statement. And when I say automatically, there is some work that has to be done first dealing with these pesky mixed cost behaviors. So as mentioned, some expenses are easy to classify. Rent, mostly fixed. Dining out, mostly variable. But some costs contain both components simultaneously, and these are mixed costs. And one of the best examples is electricity. Part of the bill exists simply because the property is occupied, but another portion changes based on actual usage. So how do we separate these two components? This is where analysts use cost behavior analysis. So here's the core idea. We collect monthly electricity bills, and we look at the monthly electricity usage. Then we analyze the relationship between the usage and the total cost. So let's consider the variables. In this analysis, usage becomes the X variable and total bill becomes the Y variable. As usage increases, the bill generally increases, but not perfectly, and that's important. We then calculate the line of best fit. And this creates an equation that takes the form of, remember back to high school days, y equals mx plus b, or you may have seen y equals a plus bx, where y is equal to your total electricity bill, x is equal to the electricity usage, a is equal to the fixed component, and b is equal to the variable cost per unit of usage. This equation separates the bill into your fixed behavior and your variable behavior, which is exactly what we want. Now, the critical insight, the intercept, A. This represents the fixed portion. This is the cost that exists even if usage were theoretically zero. So examples, connection charges, delivery fees, and base service costs. The slope, B, represents the variable component, and this tells us how much the bill changes for each additional unit of electricity used. That becomes extremely useful for forecasting, budgeting, and stress testing. So why does this matter? Now the electricity bill can be split into fixed behavior and variable behavior, meaning the personal contribution income statement becomes more accurate. Instead of classifying the entire electricity bill as fixed or variable, we can mathematically separate both components. This is exactly how analysts and managerial accountants think. Why this changes our forecasting? Well, once you know the fixed component and the variable component, you can forecast future electricity costs much more intelligently. If usage changes, only the variable portion changes. The fixed portion remains stable. This dramatically improves forecasting quality, scenario analysis, and financial planning. Now, for our purposes, because we can't just turn off the electricity or turn off the gasoline to avoid the variable components, we may just want to take sort of the historical amounts of these usages and use those for our contribution statement, which means that 90% or 80%, whatever you're comfortable using, is going to be a fixed cost, and maybe only 10 to 20% is going to be variable. And what that variable looks like, and this will cause some of you to laugh, is if you've had people in your past and parents telling you to turn the heat down or complaining about who turned the heat up, this is exactly the reason why. The higher the heat goes, the more consumption, the more variable cost per kilowatt hour or per cubic meter of gas usage. And the lower that you turn it, the less the consumption. So there you go. Now you have an explanation as to why your parents were the way that they were. So now we reorganize the income statement, not by expense category, which is how our personal income statement was organized before, but by cost behavior. So our personal contribution income statement will look like as follows. The income category will stay the same. Any salary or side income will stay at the top. But now we're going to add our variable costs first. So things like gasoline, dining, entertainment, shopping, those things which you've classified as variable costs, we subtract those from our income, and that gives us our contribution surplus. Next, we have our fixed cost categories: our rent, our insurance, our phone, and our debt payments. We would classify the variable component of the mixed cost to the variable cost section and the fixed cost component of our mixed costs to the fixed cost section. We subtract those and we get our operating surplus. This changes how you interpret your life financially. Now let's compare two lifestyles. Both individuals earn $7,000 per month, but their financial structures are completely different. Scenario 1 is the trailer park lifestyle. This individual has low housing costs, an older vehicle, lower insurance, and fewer long-term obligations. Their fixed costs are low, but their variable spending may fluctuate more. The result, their lifestyle is highly flexible. If income drops, they can rapidly reduce spending. Financial pressure remains manageable. Scenario 2, the mansion lifestyle. This individual has a massive mortgage, luxury vehicles, high insurance, expensive subscriptions, and large recurring obligations. Their fixed costs dominate the system. Even if discretionary spending stops, the financial pressure remains enormous. So here's the critical insight. The mansion lifestyle may appear wealthier, but it is often far more financially leveraged, and leverage creates fragility. So this introduces an incredibly important idea: personal operating leverage. In business, high fixed costs amplify both upside and downside. The exact same thing happens personally. High fixed cost lifestyles grow quickly during good times, but become dangerous during income disruptions. Low fixed cost lifestyles provide flexibility, adaptability, and resilience. This is why some people panic during layoffs, while others remain relatively calm. Their cost structures are different. So once expenses are classified correctly, forecasting becomes dramatically easier, because now you understand which expenses scale, which remain fixed, and which create financial pressure. This becomes the foundation for stress testing, emergency planning, job transition analysis, and long-term forecasting. Most people analyze spending categories. Analysts analyze cost behavior. This is the difference. The personal contribution income statement helps answer, how flexible is my financial life? And that may be one of the most important financial questions you can ever ask, because wealth is not about, or not just about, how much money you make. It's about how much pressure your lifestyle creates. In the next video, we move from income statement analysis to net worth analysis, because not all assets build wealth equally, and not all liabilities destroy wealth equally. We'll break down productive versus consumptive assets, good debt versus bad debt, and why your net worth number alone can be dangerously misleading, because understanding your financial position is very different from simply calculating it.